So we sit down first and we talk about what are your goals. So for instance, if you're at $1 million in gross revenue and you want to grow to $2 million in gross revenue, taking into consideration any kind of seasonality or anything else that's going on, or maybe you're closing like this big deal in a couple of months, taking all that into consideration, and we actually map it out month over month over month. And then what is affected by that revenue? So if your revenue builds, typically your payroll will go up, right? If you have a product, your cost of goods will go up. The cost of that to create that product. A lot of other things might stay the same, or some things will increase. Maybe your insurance will go up. So we take into account all the different things that will be impacted by a change in revenue. And then we map out where do you need to be in profit. And it's usually higher than what your competitors are at or where the standard industry is at, because we don't want to be standard. We want to be above standard. So we map out what that profit would look like and how much cash you need. And like just as a typical amount, we want you to have a minimum of 3 months of cash of all of your expenses in the bank. Some people say at least a minimum of 3 months worth of payroll. I like having a minimum of all of your expenses in the bank. That gives you cushion. So when we map all of that out, what we do is we meet every single month. And then we say, this was what we targeted as the revenue and all of the other numbers. This is what actually happened. And here's the variance. And then that starts the conversation. Why didn't we get to these numbers? Or maybe we overspent, maybe the revenue wasn't as high, maybe payroll was a lot higher. Those conversations are where the magic really happens, because then you really start understanding your business as a living, breathing being, because it's an entity unto itself. So you really start understanding the dynamics of what levers affect other things.